There are 6 tests on your cash flow statement that tell you whether your business is healthy, dying, or just lying to you, and most CEOs can't name 3 of them. By the end of this video, you'll be able to name all 6, and you'll know exactly which one is breaking inside your business right now. I've spent the last decade working with more than 400 CEOs across 28 countries and 24 industries, and the pattern is always the same. Everywhere. They look at the bank balance, they look at the P&L, they don't open the cash flow statement, assuming they even have one, and that is the one document where everything that actually matters about a business actually lives. And here's what the data confirms. Industry research from KPMG and from Ernst & Young consistently shows that the gap between operating cash flow and reported earnings is the single earliest visible indicator of mid-market distress, surfacing on the cash flow statement 12 to 18 months before it shows up anywhere else in the business. And the CFO usually doesn't flag it. The CEO usually doesn't open it, and by the time the bank notices, the conversation is already harder than it had to be. Now, these cash flow tests, all CEOs should run monthly. 6 tests off your cash flow statement that tell you what your P&L can never tell you. So let me walk you through them in order. The first test is the gap between your operating cash flow and your net income. Now, these 2 numbers should track each other reasonably closely over time. When they don't, when net income is climbing and operating cash flow is flat or declining, something is hiding on your balance sheet. And it's almost always one of 3 things: receivables stretching, inventory building, or revenue being recognized faster than cash flow is being collected. All 3 sit on your balance sheet. None of them show up on your P&L. And all 3 are draining cash while the income statement is telling you that the business is healthy and doing great. Not long ago, I worked with a manufacturer that was growing 22% year over year. Net income was up every quarter for 3 years running. Operating cash flow was flat the entire time. And when we pulled the balance sheet, $4 million were trapped in receivables and inventory that had silently expanded over those 3 years. And by the time all that surfaced, they had 2 quarters of liquidity left. They didn't even know it. And that pattern is not isolated. I worked with a $60 million engineering firm where net income had climbed 24% over 3 years while operating cash flow declined 11%. The CFO presented the income statement every quarter. The bank kept increasing their line of credit, which the CFO actually mistook for a positive sign of business strength, not bank greed and not a weakening balance sheet. And nobody opened the cash flow statement. So by year 4, accounts receivable had grown from 6 million to 14 million. The business was bleeding their own cash onto their customers' balance sheet, and the income statement made it look like the best 3 years in the company history. Now, once they followed our guidance and they tightened their days sales outstanding, they restructured payment terms with 4 large clients, and they installed a monthly cash flow review at the board level. Operating cash flow recovered 18% inside of 2 quarters, and they were finally able to pay down their line of credit for a change. Meanwhile, net income barely moved all this time. This first cash flow test is what surfaced this problem in time for them. So here's the verdict. If your CFO presents net income and mentions nothing about cash flow, they're not your CFO. They're your bookkeeper with a better title. So let me ask you this. When was the last time you sat down with your CFO and traced the gap between your net income and your operating cash flow line by line? If you can't remember, that's your test number 1. The second test is your operating cash flow divided by your EBITDA. That's a version of what is called the cash conversion ratio, and it shows you how much cash you're collecting for every dollar of paper profit that you're recognizing. And this ratio should sit close to 1. And when it doesn't, when EBITDA climbs and operating cash flow lags behind it, you have a working capital trap building underneath your earnings. The bigger the gap between these 2 numbers, the bigger the trap behind them. Now, a healthy mid-market business runs that ratio between 0.7 or 0.8 and 1.1 over a rolling 12-month period. And when I see a company below 0.7 for 2 rolling quarters, I know that there's a potential cash crunch coming, and the CEO doesn't even see it yet. And here's the practical translation. If your operating cash flow is 60 cents on every dollar of EBITDA, you have a working capital trap. If it's 80 cents, you have a healthy business. And if it's 100, you're either very disciplined about working capital or you've harvested it short term in a way that won't repeat. The ratio over 12 months rolling tells you which one of those three situations you're actually in and which conversation your bank is about to have with you. And by the way, if this is useful, please subscribe. I do this every week for CEOs and executive leaders. All right, the third test is your capital expenditures relative to your depreciation and amortization expenses. And here's what most CEOs miss. If your CapEx is consistently lower than your depreciation and amortization for 2 or 3 years in a row, you're not running a lean business. You're running a slowly decaying one. Your assets are wearing out faster than you're replacing them. This is invisible in your EBITDA because depreciation and amortization get adjusted as a non-cash expense. It's also invisible in your bank balance because that's cash you're not spending on CapEx. It's sitting in your account. It's looking like a cushion. But every year you underinvest in your physical asset infrastructure, that gap compounds, and eventually one of three things will happen. Number one, your equipment will fail and you're going to take a forced CapEx hit at the worst possible time. Number two, your buyer ends up flagging it during due diligence and will discount your multiple as a consequence. And number three, you will wake up 2 years into the future needing to spend 3 times what you should have spent all at once. Now, the CEOs who scale past this learn to check CapEx against depreciation and amortization every year. Because when CapEx consistently trails depreciation, your balance sheet ages even when your income statement looks fine. And 5 years of underinvestment means that a buyer that shows up with a quality of earnings report ends up adding 2 years of catch-up CapEx to your valuation math. That single adjustment can cut more than $1 million of normalized EBITDA off your sale price, and most owners only find out about it 3 weeks before closing. All right, your fourth test is the change in the so-called non-cash working capital adjustments. Now, if your business is growing and this number is significantly negative, meaning working capital is consuming cash, that's normal to some extent, because growth burns cash. But the size of that consumption tells you whether your growth is sustainable or whether it's eating you alive. Now, as a rule of thumb, if your working capital consumption is running at more than 20% of your revenue growth, you have a problem. You're growing into a cash crisis. And the faster you grow, the worse it's going to get until either your growth stops or your cash does. And of course, you can finance some of that working capital with your bank, but at that rate, it maxes out your leverage capacity pretty fast. Now, those 4 tests tell you what's happening inside the business, and the next 2 will tell you what's coming at you from outside the business. The 5th test is your free cash flow after debt service. Now, this is the cash you can actually deploy. Operating cash flow less your maintenance CapEx, less your required debt principal repayments. Everything before this number is theoretical. Everything after this number is what matters. I cannot tell you how many CEOs make capital decisions based on a free cash flow figure that has not yet cleared debt principal payments. Their finance teams will present it like it's available capital, and the CEO will greenlight an acquisition or a hire wave or a dividend, and then one day the cash balance suddenly is insufficient to clear the loan payment because they spent cash that was never available to spend in the first place. Now, the companies that compound in value are not the ones with the biggest operating cash flow on paper. They are, however, the ones who know exactly how much of it is actually theirs to use. And here's the math that makes this test concrete. Take a business reporting $4 million of EBITDA. Subtract $1.5 million for working capital investments to get to about $2.5 million of operating cash flow. Then take out another $800,000 of maintenance CapEx, take out another $600,000 of mandatory debt principal payments, and you're left with $1.1 million of real deployable free cash flow. That's 28% of the headline EBITDA number, and you haven't even funded your growth CapEx yet. That gap, every dollar of it, is the single largest source of capital decision mistakes in mid-market companies. And finally, the 6th test is the pattern of your cash flow from financing activities over multiple rolling periods. Now, in a healthy, self-sustaining business, financing activities should be balanced or net negative most periods because you're paying down debt, you're returning capital to shareholders, or you're doing both. But when debt financing activities are constantly positive, when cash from financing is making up for cash you are not generating from your operations, that's the single biggest late-stage warning in the cash flow statement for you. And that means that you're funding your operations with borrowed money. That means working capital and operating shortfalls get plugged by new debt issuance. And if your financing line has been positive for 3 or 4 quarters running while operations are net cash flow negative, you really should be concerned, because most likely your bank already is, and they're just waiting to have that conversation with you. And here's what makes this test so dangerous in mid-market companies specifically. When financing activities are positive for several rolling quarters, the business has structurally shifted from being self-funded to being externally funded. And most CEOs don't see the shift until their banker wants to have more meetings and starts asking more questions. The pattern is operating cash flow negative, investing cash flow elevated because they keep growing CapEx, and financing cash flows elevated to plug the gap. 3 lines, 1 pattern, 1 trajectory, borrowed money standing in for missing cash flow generation. So of the 6 tests, operating cash flow versus net income, operating cash flow versus EBITDA, CapEx spend versus depreciation and amortization, the changes in working capital, free cash flow after debt service, and the financing activities pattern, which one have you never run? Drop a number in the comments. Let me know. And here's what I want you to take away from this video, specifically about your cash flow statement, is that it's the only document in your monthly package that tells the truth without filtration. Your P&L gets adjusted. Your balance sheet gets reclassified. Your bank covenants get reset. The cash flow statement just shows what moved. So if you run these tests every month in the order I just walked you through, you will see your business and how it's doing months in advance, because the writing is on the wall before any other document will tell you. So here's the bottom line. Your P&L shows performance, your balance sheet shows position, and your cash flow statement shows protection. That's the truth serum. And it lives inside those 6 tests that most CEOs never run in order. And the ones that do, the ones that can actually trace the math between their operations to working capital, to debt service, to investments, to financing, those are the CEOs that walk into bank meetings or board meetings or buyer meetings and don't get surprised. And if you're watching this and thinking you need to actually get this knowledge and build this visibility into how you run your own business, that's exactly why I built the CEO Financial Intelligence Academy. It's a 12-month membership where you get the full financial intelligence curriculum you need as an executive through a live cohort with me. You get your own CEO finance dashboard, custom built on your actual sourced accounting numbers from day one, and you get access to the CEO Finance Circle, which is our global community of CEOs working through the same decisions that you are. You can attend live or you can watch recordings on your own schedule at your own pace with full access for the full year. Now, Troy Kent, president of Kent Power, said he cannot recommend the Academy enough because it helped them understand and drive free cash flow and enterprise value at the same time. And that's a 650 employee business testifying to the value you get inside the Academy. Now, if that sounds like something you need, the link is in the description below. And if you want a starting point right now, go take the CEO Financial Intelligence Blind Spot Diagnostic, which is a 3-minute diagnostic on the Academy website with personalized feedback on exactly what your blind spots are and what to do about them. The link is also below in the description. And while you're at it, go ahead and subscribe to my weekly newsletter, The Finance Gym, and join over 45,000 CEOs and executive leaders to upgrade your executive financial leadership and to get my best infographics for free. The link is also in the description below. And remember, reading a cash flow statement takes financial literacy, but commanding it takes financial intelligence. I'll see you in the next video.